So, okay, students, so we have done up to here with the financial instrument basics, financial assets and the liability. Compound instrument, I hope you are very clear about it. Compound instrument, you have gone through, you have understood, you have checked that. Yes, now we will come to another very important aspect called derivatives, derivative accounting. Very simple form of accounting, only two journal entries. Two journal entries. So we have to choose one among the two journal entries, that's it. Now, let us first understand the theoretical part of it. Yes. So, what is the derivative? What we are going to discuss here in the derivative contract. See, we discussed about the derivative. Derivative can be a derivative financial asset or a derivative financial liability. Initially, we discussed about the definition of a derivative. What is a derivative contract? Derivative contract is any contract whose value, it's a contract, just like a financial instrument. But its value depends upon the value of something else. That means it is not having any value on its own standalone basis. Its value depends upon one underlying. That means this contract is on something else. And if the value of that underlying is going to change, like a contract to buy the share in the future, the share is the underlying here. If the share price changes, the value of the contract changes. Second, no initial investment or this very small amount of investment. If you want to get the benefits of the shares, the appreciation, right now you have to go and buy the shares. Rather than if today only if you enter into share contract to buy the share price at today's price in tomorrow, day after tomorrow or whatever, then you got all the benefits of buying the shares without buying the shares. You understood what I mean to say? Suppose today's the market price is S0 is equal to 100. Right now the market price. Now you think that the share price is going to go up. It's going to become 150. Now if you want to get that benefit of 50 rupees, what do you need to do? Right now go and buy one share. And to buy one share, you have to make full 100% down payment, 100 rupees payment. Instead, what plan you can do? You can go today to the stock market or F&O market, look for anyone who is ready to give you a call option or future buy at rupees 100 only. That means after 1 month from now, I will buy from you at 100 rupees. Okay, did you pay anything? Nothing. After 1 month, if the share price is going to become 150 as you anticipated, now the another party will give you 50 rupees. Difference between what was agreed to be sold by him and what is the actual market price. How much profit you made? 50 rupees. It is the same amount of profit you would have made today if you would have invested right now. That means with 100 rupees investment, you got 50 rupees in the cash market. In the derivative, with zero investment, you got 50 rupees. That's why it's called derivative. And its price depends upon, its settlement is going to happen in the future. Now we discussed there are 4 types of derivative contract. It can be forwards, futures, swaps and options. Now how do we account a derivative contract? Initial recognition on the day you enter into and sign the contract. We discussed a financial instrument has to be accounted the day it is signed, because then some of the party get a right and obligations. Suppose if it is a forward contract, generally what happens in a forward contract, nobody pays. I just tell, okay, I want the food on so and so date. Yes, I entered into a derivative contract. So on the commitment date, when entity becomes a party to the forward contract, the fair value of the rights and obligation is often equal to the net fair value, which is 0. See, you didn't pay anything. He didn't pay you anything. Like suppose you want to travel after 1 month from now. You call one hotel. Sir, I want one booking. Can you do one booking? Is it a forward contract? And he says, yes. I'll ask, what is the price? Say 5,000 rupees per room. Is it finalized? Is it a forward contract? Yes. You ask him, my booking is confirmed. Then he says, look, sir, you have to pay me 1,000 rupees in advance. Now this forward contract demands one advance payment. That means there is one fair value, no? That means I need to pass an entry. What is that entry? What entry I should pass? Forward asset account derivative financial asset account debit to bank the day I pay. If I don't pay, but simply I booked it, I need not pass any entry. Option, I pay the premium, I need to pass the entry. Option premium asset account debit to bank. And from next day onwards, MTM is going to come into picture, mark to market. Hence, no accounting entry is passed if you don't pay, if you don't receive anything. Just forget it. On day one, you just sign the contract. But option contract doesn't work like that. In option contract, it's like a forward contract only. In forward, there is no premium. So this indicates that the fair value of a forward is zero. But option holder pays the upfront premium to the. Actually, when you told, no, sir, I want one hotel on so and so date, is it a forward or an option? It was an option. Because why he asked 1,000 rupees upfront premium? Because you may not turn back. So it's not a forward. In a forward, what happens? No, you have to, even though you don't go, like for example, you book it through makemytrip.com. Suppose, and they have got a policy of cancellation. That means if you cancel it on the last moment, 100% will be deductible. You don't turn back only. Oh, you say I will not go. Do you know what they will do? Next time when you do the booking, they will deduct your money. That is the forward. Forward you have to oblige. But if it is an option, you don't need to oblige. So when you paid that 1,000 rupees advance, no, it is actually an option contract. That's why this provides evidence that there is a fair value to the option contract. It is not zero. That's why you have to recognize an asset or liability. I hope it's clear to you. Yes. From next day onwards, subsequent, see, derivative contracts, you call it asset or you call it liability. Always it is held for FVTPA. That means you will always find the fair value, differential amount, you will take it to P&L account. Thus, you have got only two accounting entries. That's why, can you see such a simple thing? Only two accounting entries. Either you will be passing derivative loss account debit to derivative financial liability if you are in an unfavorable situation, because derivative contracts are zero sum game. Your profit, other person's loss. No win-win situation there. And if you case a favorable situation, you have got a derivative financial assets to P&L gain. See, always students, see, when you make notes, yesterday only I was coming across something. There is one beautiful concept called the mind mapping. Okay, please try that. You can check in the Google also. See, what is the concept of a mind mapping? Mind mapping is, rather than you write all the story what I have been told, like this you write, no? I think you must have written some story. Mind mapping goes with the concept of a tree. Practice. It becomes your asset going forward. Every subject. When you want to make a notes like this. Don't make a notes in a narrative. Don't write the theory. Think. See, it requires a practice. It's an art. Then you try to connect the thing. Okay, so the forward has got these two options. This is this. It will go like this. So you know, actually, literally, you are preparing a chart. But what happens at the back end? There is a mapping is going to happen to your concept. See, you learn better rather than theoretically writing everything. And it is a skill. Initially, you may not figure out how to do it. But as and when you do it, no, so you will understand it. So it will save your time also. It will exactly give you a picture like how I should be documenting it, what it means. See, you remember first day I taught you all definition of financial assets, financial liability. Next day when I started, you remember I started like this, one map. I said we have got a financial instrument, one like financial liability. See, this you are able to grasp it faster, better. In exam, don't write this. It is not awarded in marks. Exam, you have to give the language there. But this will make you conceptually very strong. So going forward, try to practice that way. When you want to make a notes like this. Yes. So are you clear now, students, about the two entries? Easy, no? But only one thing. Now comes AFM into picture. Among these two, which entry should I pass? That's what you need to figure out properly. Am I in a favorable or am I in an unfavorable? If you miss, you will pass ulta entry. Followed, no? Now let us discuss about the own use exemption. You remember I told you at that time. We will discuss later. Now, as per this, no, every forward contract, every option contract, I need to pass an accounting entry. I have to treat it like a derivative, correct? Can you see, students, in any organization, how many purchase orders will be issued? Purchase orders, how many purchase orders will be issued? Like I want to hire one faculty here to teach. I will give you one purchase order, no, right now. I will tell him, you come and so date for teaching. This is your fixed money. Derivative contract. You have got college day. You ordered one food. Derivative contract. You call one electrician. You come on 30th of April. So and so price, do this job. Derivative contract. That means every single purchase order is a derivative contract. Will you sit and pass accounting entries? Every single purchase order is a derivative contract, no? Will you sit and pass the journal entries for that? Will you try to figure out the market value of those contracts? Did I make a gain or loss by calling that faculty? His market rate may be more on that day. It's going to cause a lot of unnecessary hardship for me, correct? That's why they gave one exemption. It's called the own use exemption. It says that, look, if you want to buy or sell a non-financial asset, then 109 you need not apply, provided you are entering into the derivative contract for your own use, not to trade, not to speculate. Followed, no? Like purchase order you have placed for steel. You are a steel manufacturer, billet manufacturer. You need pig iron. You have placed one order for pig iron. Now the contract value will change from tomorrow onwards, because that is like a forward contract. So will you do mark to market? So many purchase orders you have placed. That's why there is a standard gives one exemption, because they call it as an executory contract. Executory contracts are the one in India's 37 you are going to discuss, on which both the parties have not performed anything. It is still executory, yet to be executed. Now, in such case, entity may treat such contract as a normal purchase and sale and need not apply derivative contract. There is one question on this, later we will discuss. So, you ignore it. Followed, no? This exemption relieves the entity from applying 109 on every purchase and sale in day-to-day key activities. Then, if the moment exemption comes, no, people will try to take the advantage. You place an order for steel, okay, telling I want pig iron. Next day onwards, the prices started to fall. Did you make a gain or loss in that contract? Loss, no? See, when you are talking, you placed an order today, S0, today, time 0, you placed an order to buy steel at rupees 100 1 month from now. Very next day, the price of the market price of the steel came to 80 rupees. You feel unhappy, no? Because if you would have waited, you would have got at 80 rupees. Now you have placed an order and you have to buy at 100. You made a loss. Then tomorrow, if audit is going to happen, they will come and ask you, show me the purchase order. What you will tell? Sir, this is, they will pass you. Why did you pass that? Why you didn't pass the accounting entry? You say, sir, this is for my own consumption. Why? Because you made a loss, no? You placed an order today. Tomorrow the market price is 120 rupees. You are very happy. And you will treat it as a derivative contract. And pass one accounting entry. Derivative financial asset accounting to derivative income. Why? Your profit increases. Then when auditor comes and asks, sir, what is this? So that I did for trading. So you will try to take the advantage of this exemption for your benefit. Whenever you make loss, you will say it is for my own consumption. Whenever you make profit, you pass the accounting entry and book the gain there and bring the profit into the books. Followed, no? So should I not restrict you from that? Tell me, how can I restrict? Chalo, you tell me. You are the designers of standards, no? There is one challenge now. And then shall I tell I will not give this exemption? Then there is a big challenge. What is the big challenge? Even my own consumption also I should pass accounting entry, track the market prices. So somebody will ask me, company is going to ask me, sir, should I focus on my business or should I focus on accounting here? Get the market price, sit and check the market MTM. So I face two types of challenges. If I don't give exemption, there is a challenge. If I give an exemption, still there is a challenge. Now you are all accountants. Now tell me, how can I solve this problem? Sorry? Initially, okay. Initially only I'll decide. Okay, initially only I'll decide. But I can still hide, no, there. See, I'm anticipating increasing in the steel price. I wanted to take advantage. I can hide one embedded derivative in this contract. No? And I can say it's for my exemption or own use. I can do anything. So for this, it should pass through certain tests. Like SPPI test, business model test, asset purchase test. So many tests we are going to come across in India's. What is that test? It says that, look, this exemption is available in a good faith. I'm giving you this exemption to relieve you from accounting, not for speculating there. Now, when this is not available to you, it is not available if the contract to buy that non-financial asset is settled net in cash. You tell me on earth, you said that I wanted to buy it for my own consumption. Will you ever settle in cash? Like you placed one order for 250 people to have food. Why? You said, sir, it is my birthday. Now, on the date of birthday, you tell that caterer, sir, don't give me food, give me the differential cash, or I will pay you the differential cash. That means on day one only, your intention is very clear that you wanted to trade actually. You don't want to get the delivery. Followed, no? Now, then you need to define what do you mean by settled net in cash. See, when the terms of the contract permit to settle in net, that means one clause exists. That clause says, okay, if any one of the party doesn't want the delivery, they can offer net settle. Such type of contract have you seen? That means, okay, one contract, you tell one rickshaw guy, tomorrow midnight, 1 o'clock, you come to railway station to pick me. Okay, I'll give you option and I also have an option. We will settle net in cash. That means, if you don't come, I will travel by taking somebody's rickshaw, you pay me that differential. Followed, no? This type of contract you don't enter, no? You say either come or don't come, that's it. So your terms should permit it, or there is a practice of selling them, even though it is not explicit. The moment you understand, oh, if I enter in the terms, then only you do it, no? What if I will not enter in the terms? But what is your practice? As an auditor, I have to look into your practice. How many times in the past, in past 10 purchase orders, how many times you settled it? Understood? Okay. Then, okay, you want settlement now. That's why what I will do, I will take the delivery. Then the standard says, look, when the entity takes the delivery and sells within the short period, I will not permit that also. I know that. If I give you one exemption, you take that benefit of exemption. If I say contract, you don't enter into the contract. Without contract, you would have the practice of net settlement. If I say that is also not permitted, then you will take the delivery yourself. So you should take delivery, consume it, don't sell it in the market. Or when the contract is readily convertible into cash, that means you don't sell. Say for example, gold. It can be readily converted into cash, no? I will not permit you. For gold, if you enter into forward contract, please account it as a derivative contract. Because I can't differentiate your intention now. Did you take it for own consumption to prepare the ornament and sell? Or did you enter into to take the advantage of the price changes? I cannot decide it. Followed, no? This is one condition called net settlement. If this condition is fulfilled, then Ind AS 109 is applicable. If this is not fulfilled, then check for the second condition. A contract to buy or sell non-financial item settled in cash are irrevocably designated as FVTPL. Oh, that means the original contract, post contract, you have designated as FVTPL even though entered into own use. That means you wanted to account it as an FVTPL, the original contract. If that is the case, then pass the entry for derivative also. No, because derivative also FVTPL. Like for example, entity entered into future sell after placing purchase order and want to do hedge accounting. Like I placed in purchase order. Now my prices may go down after buying. So I go to the futures market and I will do one futures sell. I will take an opposite position and I will hedge it. This future sell is a derivative contract. Purchase order I didn't account only. Now, what you can do, future sell contract you have to account, correct? No, because it is a derivative, MTM is going to happen there. But did you account purchase order? No, it is for your own use. But what you can do, you can designate this purchase order as FVTPL. That means you can treat it like a derivative contract so that two derivative contracts will offset each other and kill their effect. Otherwise, one derivative contract you will never account only, another derivative contract you will show profit or loss. But actually in reality there is no profit or loss. The profit made in the purchase order will be offset by the future sell, or profits made in the futures market will be offset by the purchase order. Did you get connected, students, what I am trying to tell here? Both should, because one is both are derivative. Both are derivative. One is accounted as derivative. Another, since you are buying it for your own use, you didn't account it. Then standard says, look, if you designate it as FVTPL, then you can't take this own use exemption because you are performing hedge accounting there. And third beautiful thing comes. Guess what? No, initial day, on day one, if I had entered, you explained all these things. It's a confusing thing. Now it makes more sense to you because we have gone through classification and all other stuff. It says that, look, you have given one return option. Return option means what? You have given an option to the opposite party. You are an entity. You have given an option to the other party to buy or sell non-financial asset that can be settled net in cash, where such contract was not entered for the own usage. That means here you granted an option to the other party to buy or sell. Like generally when you go to one caterer, place an order, you try to retain that right to place the order or not to place the order. Like today you placed the order. Can you go and cancel tomorrow? Yes. Will he pay your advance money? No, he will not pay. No. That's the premium he has taken because he has blocked for you. And tomorrow you say, last moment, I don't want. He can't do anything. Followed, no? But what happens is, you have given an option to him. That means you have purchased order. You have placed one order. Give me food for my birthday. And you have given an option to him. Okay, if you want, you supply. If you don't want, you don't supply. Now, again, students, at this point of time, this is much theoretical for you. There is one examination question. Very beautiful question. At that time, we will discuss about all this theory again. So, if any one of these three conditions is fulfilled, even though an order is placed for your own use, you don't get that exemption. You have to pass one among the two entries. And if you claim own exemption, you need not pass derivative accounting. Are you clear? Yes. Now, before we start with the embedded derivative, we will solve some problems on derivative so that you become strong and then you understand what is embedded derivative, because there are theoretical things involved here. Yes, friends. So before we proceed further, just a very quick recap. Under derivative, derivative is the contract whose value will be derived from the underlying assets. It can be commodity, debenture, swap, etc. Now, for the purpose of accounting, its value is going to change. No or initial net, very little initial investment and future settlement. This condition has to fulfill. Then only we can call it a derivative contract. Now, forward contract is one where today you have agreed to sell, because if you are a farmer, you have grown onion prices can be 120 when harvest is going to come, or it can be 10 rupees also. So today only you enter into contract with somebody that on 31st March I will sell you 100 tons, which harvest is going to happen at 50 rupees per ton. So my position is hedged. For going forward, whether the price is 120 or price is 10, I am going to get fixed 50. When I am happy, forward seller is happy if the price is going to become 10 rupees because he could realize 50. Forward buyer is happy if the price is 120. And this guy can be a speculator, hedger, or God knows who is he, or an arbitrator. There are three types of people. Anyhow, the contract happens. This is the future is the same contract. Forward and futures are same except there is an intermediate. Option contract is also same like futures except this guy is an option holder. He has got a right to sell or not to sell. And this type of contract is called a put option. So that he has to pay the premium to the opposite party. So there can be two types of option called a call option and put option. Call option is also called a buy option. Put option called a sell option. Put option holder, writer. Call option holder, writer. Yes, with the AFM your concepts will be much sure. Now the last is the swap. That means you have invested with the fixed, but you don't want fixed. So you can swap with one swap bank where you pay fixed to him, variable you are going to get. This is the one of the swap contract. I told you only 2 entries. Okay. Measurements needs your AFM understanding. Now what is mark to market? Mark to market means my previous fair value minus my new fair value. The difference is the market price changes which I charge to P&L. So how does this entry comes? It is nothing but the difference between previous value of the asset and the new value of the asset. That process is called a mark to market. Okay. Did I tell you about this pricing of this? Okay, understand this example. Now, because in one of the exam question, you have to apply this logic. For this, understanding is very important. Today is 1st of January. On 30th of June, your friend's wedding is there in Delhi. So what do you need to do now? You have to book a flight. So you go to you log in into makemytrip.com. You see the prices. Right now 4,000, June 2030th 5,000 rupees. What you will do? Which price? 4,000. Okay, if you book at 4,000, then immediately you have to catch the flight and go to Delhi. That's called a spot. Spot means right now. If you paid 4,000, no, they will give you ticket then and there itself. Sit in the flight, go to Delhi. What you will do Delhi right now? Mehndi is there right now. What is there now? There is nothing. Your friend will be surprised. Why you came? I came for your marriage. Marriage is in June now. What you have come for? So today you would have booked a flight for 5,000 to travel in the future. Did you pay anything? No. You may not have paid. You just booked it. On which day you have to pay? Say for example, right now you have to book upfront payment. That's why it is not a derivative because one of the conditions failed. Otherwise, for example, let us assume you paid only say 10% booking fees. Entire fees you will pay on the day. Now 31st March came. June price is 3,000. Spot price is 6,000. Are you happy or sad? You are sad. Why? See, what is this spot? That means right now on 31st March if you have to travel, you have to pay 6,000, which is irrelevant for me. It is irrelevant for me. For me, comparison point is, what if I will book today for the travel in the future versus what I should book here on the travel in the future? You just curse yourself. I should have waited. I did hurry burry. Just 2-3 months if I had waited, I could have saved 3,000 rupees, 2,000 rupees per ticket. Now on the date of travel, see, future is not applicable. Spot is 8,000. Are you happy or sad? Huh? You are happy. Why? You take my decision is very right. I booked at 8,000. Yeah, you could have got still better price. You would have waited, but there is uncertainty. That's why it's called derivative. But today you actually saved 3,000 by entering into this contract. So when you do this MTM, understand students, your spot price in between is irrelevant for you. You compare futures to future. Have you understood this concept? Okay, because don't get confused, because they will give you so many rates there. Take out question number 42. This is my own example. On 1st of January 2011, Samco company entered into a forward purchase contract. That means today I have agreed to buy $20,000 in the future from JT Corporation to be settled on 31st December, end of the year. At which rate I am going to buy? 68 rupees per dollar. No consideration was paid or received upfront. That means fair value is equal to 0. On the day 1st January, when both the people sign the contract, we are not going to pass any accounting entry. Samco Limited is a listed company. What happens? Why this information is important for me? Ind AS 33 becomes applicable. Quarterly financial statements. You are listed. The moment you have to prepare a quarterly financial statement, you have to do MTM, mark to market, and prepares the financials on a quarterly basis. Below are the exchange rates. Now the forward rate bar spot rate on 31st March is so and so. Forward rate, spot rate on the, see, what is this forward rate? On this day for 31st December. Forward rate they have given you September, the spot rate of 36, because last day they will not give you. Generally they will not give you. If at all they give you, you have to compare forward to forward only, not forward to spot. Always, in every cases, always comparison should be forward to forward. If forward is not available on the date of settlement, then forward to spot. Now, what is mark to market fair value of the contract of Samco Limited? Okay, so here we are not accounting, okay, we are just calculating gain or loss. Just to have a recap of our AFM principles. Okay, first write MTM fair value, mark to market. We will write the date first. On 1st of January 2011, what did you do? Forward buy. Your position is forward buy. Okay. Now how much is the value? It is $20,000 into rupees 68. Why did you multiply? Why did you multiply here? Because your transaction currency and the base currency are one and the same. Again, coming from your AFM principles. Other simple, $1 is equal to 68 rupees. 28% is equal to $20,000. How much? Now, did you made any P&L on the day you signed the contract? No. What is your cumulative? Nothing. Cumulative is also nothing. Okay, now comes 31st March 11. You need to do mark to market because settlement didn't happen, but the prices of the forward change. Now tell me, students, on 31st of March, are you happy or sad? On 31st of March, okay, students, just one thing. Yeah, this is anyhow my example question. So go back to the example and just remove these numbers, okay? Okay, fine. Sorry, I'm okay. Now tell me, I'm happy or I'm sad here? Why? At what price you agreed to buy? 68. What is the price now? So happy or sad? You are sad, no? Because after it's forward buy. After you agreed to buy, and will you compare it with the spot? No, spot is irrelevant to you unless the contract gets settled there. So you are very happy, or you are very sad because you have agreed to buy at 68, and after you agreed to buy, the prices have come to 66.75. So how much loss did you make? Can you tell me? How much loss did you make? 25,000. How did you get? $20. $20,000 into 66.75 minus 68, 25,000 loss. What is your cumulative loss up to 31st March? 25,000, because previously there was no losses. Followed, no? Now comes 30th of June 2011. Again you need to do MTM because it is not yet settled now. This contract is not settled. Are you happy or sad? Huh? Sorry? What do you mean a mark to market? Mark to market means your original contract was at 68. By booking the loss, you booked the loss, you have restated your contract at 66.75. That means 68 is no more relevant to you because that much loss you already booked. No more feelings. Correct, no? Because once you booked means booked, gone. So now tell me, are you happy or sad? You are not fully happy because you still remember, even though you booked that loss, no, you still remember, but your situation is better because if you see $20,000, the price has become 67.25 and it is 66.75. Since I am looking one period, that's why it gets mark to market. If you are talking cumulatively, then you have to compare 67.75 with the 68. On a cumulative basis, you are unhappy. But for a partial period, you are happy. How much profit did you make? 10,000. Cumulatively, 15,000 loss. That's what I'm trying to tell you. If you look cumulatively, you are unhappy. So always when you talk about cumulative, you have to compare the current price with the original price. If you are talking mark to market, you have to just compare with the previous marked value. Now 30th 9/11 comes. MTM. Happy or sad? Super happy. 68.60 minus 67.25. Correct? How much is the profit? For this quarter, third quarter? 27,000. Cumulatively? 12,000 rupees profit you are sitting now. Now this time you are genuinely happy, because it has recovered all your cumulative losses and you are sitting on a profit. And now comes 31st December settlement. Now are you happy or sad in the last quarter? 66 minus 68.60. You are sad for 52,000. So cumulatively you are sad for 40,000. This is your value. Followed, no? This 15,000 you got with the cumulative. So you should be, see, when they give you the question, examination question, you should understand whether have they given you cumulative value or have they given you this or have they given you this. Others will not understand. Yes, that's it. We need not pass the entries. Have you understood the concept of how to, what is that individual calculations for the period and the cumulative calculation? Clear, no? Yes, so now we will move on to the question number 43, which is an illustration question. Read this. 12-mark question probably. On 1st of January 2011, Samco agreed to buy $20,000 from JT Bank in the future on 31st December at 68 per dollar. They did not pay any amount and it's a listed entity, so quarterly basis you have to. Same story like my example. In fact, this example was based on this story only, this question only. For the purpose of accounting, please use the following information representing marked to market fair value of the forward contract at each of the reporting date. This time they didn't give you any rates. They told you your position is 25,000 rupees. As on 31st March, your position is 15,000 rupees. Spot as on 30th September, it is 12,000 rupees and the last spot is 66,000. Now, following the principles of recognition and measurement, as laid down in 109, you are required to record the entries for each quarter till the date of purchase. So, you have to pass the entries now. Do you need to do the calculation? No, they only give no here. Output they have given. Is this the cumulative value or is it for the period? Huh? How do you know? Okay, they have told you marked value as on, followed no. Otherwise, you will not be able to understand which value is this. They have given you cumulative value, students. Understand? If the rates were given, you would have figured out like this. But the question is very silent, which value? On one side, they are telling mark to market. Followed no? So this is the cumulative value. That understanding you need to have. Should I write theory? Huh? Okay. Other than it marks, forget marks. Should I write theory? What is this? The principles of recognition and measurement. What do you mean? What did you understand with this? They expect you to understand and analyze this instrument. That's why they tell you following the principles. So is it meeting a derivative contract? First thing that you need to write, no. Following the principles, you record the entries. That means if it is not a derivative contract only, why on earth you should pass the entries, Papa? That's why they give you 12 marks. So first what you need to tell the evaluator, look, I know that this is a derivative instrument. Why? Because it meets the definition. Does it meet the definition? What are the three conditions? Sorry? Initial payment is nil. Okay, condition fulfilled. What is my underlying? Dollars. Now, instead of the, it's actually a forward contract. No, forward contract with the dollar. The dollar price changes, the contract value changes, and it is settled in the future. Okay, so write some theory. This is the cumulative MTM. Keep in mind. In the given case, so in the exam, I don't know which verb they will use. Contract is derivative as 1. The value changes on change in forex rate. The value changes based on the change in the forex rate. Say, simple language I have told you. Second, initial amount paid is 0, but it gives similar response. That means with 0 investment, I give you an example, the share price 100 rupees to 150. You are able to get that benefit with 0 investment. That means you made 0 investment, but that 0 investment gives you the same response equal to the change in the price. And the third, settlement is in future. So first you explain that this is a derivative contract. This meets the definition of a derivative contract. If it is the case, they said recognition. Recognition means only if it is derivative you can recognize it. So is it a derivative? Yes. Thus, it is a forward exchange contract. Now you recognize it. If it fails the definition, that's what they said, students. Understand the question. Considering the recognition and the measurement principles, pass the journal entry. So if it is going to fail the definition of derivative, then you will not account it as a derivative. Then there is no question of journal entries there. Means it may come not as per 109. Then you have to look which other standard will be applicable to this for this payment. Should I consider PP? Should I consider Ind AS 21? Is it a related? I don't know. We have to verify it. But since it is meeting, then you apply 109. Second, recognition and measurement. How do you measure the derivative contract? Derived, that is classification. Derivative contract is initially measured at fair value. Any financial instrument for that sake will be initially measured at a fair value. And what is the fair value of this contract? 0. Because I didn't pay anything. How it's classified? Subsequently classified at FETPL. See, very clear. You say that, look, this is a derivative contract because it meets the definition. I am going to account it at a fair value. The fair value is 0, which we will tell later when we pass the entry. And subsequent classification will be FETPL. So the differences I will be taking to the P&L account. Anybody reading your answer is very clear and could see the clarity in your mind, because you will write here only what clarity you have got in your mind. No, if you are confused answer will come here. Yes, so this is the objective. So this is what you write. Now start the journal entry. Journal entries. On 1st of January 2011, the fair value is 0 as no consideration paid or received. Since you didn't pay anything, you didn't receive anything, the fair value is 0. Therefore, no entries. On this day, you don't pass any accounting entry. Are you clear? Perfect. Now you have to tell me on 31st March 2011 what accounting entry I'll pass. Derivative loss account debit to derivative financial liability. How much? 25,000. Simple entry, no? Derivative financial liability. Derivative loss, P&L. And why P&L? FETPL. Why 25,000? They only told me. This is MTM. Yes, clear, no, Dharashri? Vidya? So I pass this particular entry in the exam with narrations. Here I am not going to pass the narration, give the narration. Done? Are you done? Okay. Now you tell me on 30th of June 11, what accounting entry I am going to pass? Huh? See, my entries, sorry, am I happy or sad? I'm happy. Okay. So 2 derivative gain is going to come because my loss got reduced. Will you say derivative financial asset? No, already you have created a liability. No, are you supposed to pay that? No, you reduce that liability. So you say derivative financial liability account debit, because see, offsetting derivative financial asset and liability can offset. Deferred tax asset and liability can offset. Simply other things you can't offset. That's why first you kill that liability because it is unnecessary. No, it's the same thing. How much? 10,000. Be very clear. Then on 30th September, happy or sad? Happy. Your gain. So 2 derivative gain P&L. How much? How much? 27,000, because your loss got recovered and you're sitting on a profit now. Plus of 10 means that whatever, how much is the plus whatever it is. That means your loss got recovered now. So then debit what? Derivative financial liability debit 15,000, because that 15,000 balance was there, that you will write off. Derivative financial asset 12,000. Easy, no? Derivative accounting. What is there? I don't know who is telling difficult. Clear? Now we will move on to 30th December, 31st of December 11. Tell me what accounting entry I should pass. What happens on 31st December? Actual transaction is going to happen. I am going to get US dollar cash. How much is US dollar? 60, 66, 20,000 into 66. Now, is this why you take 66 divided by 66? Is my accounting entry is going to happen in dollar or INR? INR, because there are, see, this is India's 21 is going to applicable now. There are two entries. One entry happens in the base currency, another is happening in the functional currency. So I have to pass the entry in rupee now. In terms of rupee, what is the value of US dollar which comes to me? I get hard dollars, a green color, 66. Why? Because US dollar is a financial asset. Is it a financial asset? Why? With whom? It's cash. Why it's a financial asset? Because it is a cash. When they cash, don't think only INR. Even dollar is also a cash to you. What is a financial asset? How should you measure the financial asset first time when it comes to the balance sheet? At fair value. What is the fair value? 66 is the fair value. So $20,000 into 66 is 13,20,000. What comes to you? You can say USD cash or INR cash. INR cash means rupee cash. USD cash means dollar cash. Now, are you happy or sad on the last day because of the forward contract? Sad. So, derivative loss account will be debit, P&L. How much? Wait, we'll keep it as a balancing figure. Balancing figure. On this day, do you have a derivative asset or liability in the balance sheet? Is it required anymore? No. So, how to write? 2 derivative financial asset. How much? 12,000. How much cash did you pay? So, somebody gave you free of cost, this $20,000. To JT Bank, did you pay any cash? To get this $20,000, did you pay cash? You paid at 68 rupees, no, at the original forward contract. So, you paid $20,000 into rupees 68. 13,60,000. So, differential figure 52,000 is your loss for the last quarter. It is your loss for the last quarter. If you want to, you can cross verify. What is your total loss? What is the price? 68. Okay. And what is your closing price? 66. So, difference with this is your total loss plus the derivative asset written off gives you 52,000. Are you clear, students? That's it, done. So simple. Now, for your understanding, I will show you. You have to practice it later. See, in the month of March, I booked a loss of 25,000. I debit it. In June, I booked a credit of 10,000. In September, again I booked a credit of 27,000. And December, I booked a loss of 52,000. This is quarter wise. Each quarter I booked a loss, separate P&L account. Cumulatively, if I look, my overall loss is 40,000, which is nothing but 68 closing contract price, exercise price minus 66 closing price into $20,000. Are you clear about this reconciliation? Yes, Dhanashree? Perfect, no? Yes. So, we will go to the examination question. May 18, this question has come in your examination. So, I hope students, you have understood it very well. Yeah, please ask me the doubts. Before I want you to solve the examination question, please be very clear. Sorry? 2 rupees loss per dollar. So, total rupee 40,000 rupees loss. No? 52,000 quarterly because there was one cumulative losses. No? In total, overall, what is your loss? Overall, See, on day 1, 1st of January, you said, I will buy dollar at 68. And actual rate was 66. Are you happy or sad? You should be sad, no? Like say, for example, to tell you in simple language, your parents agreed to purchase one plot of land right now at 10 lakh rupees. When on 1st of January, 31st December, they agreed to buy at 10 lakh rupees. On that day, the market price of the land is 8 lakh rupees. This example, no, I found people correct very well. The moment we think dollar, no, we get confused. But the moment land comes, no, we pick it. I've seen that. It's a very nice example to tell. So, prices after you agreed to buy, the prices fell down. Now, we have agreed to sell somebody one land at 10 lakhs. The moment I agreed and got the contract done, no, next day I came to know there is one dumping yard going to come next to my land. The moment dump yard comes, the prices of land is going to fall. Am I happy or sad? I am happy because from next day onward, the prices will not be that much. It's going to fall because my position is a seller now. If I am a buyer, I am happy only when the prices increase after I purchase. If I am a seller, I am happy only if prices fall after I sell. Now, who are you? Buyer or seller of $20,000? You are a buyer of $20,000. You agreed to buy at 68. Prices fell down to 66. That's why you have got a loss. But this loss, since you are a listed entity, you are not going to recognize only at the end of the year. Since your quarterly closing is going to happen every time you did MTM. That's why in one period you incurred a loss, another period you made a gain, another period you made a gain, another period you made a loss. So, because of this cumulative effect, that's why one period you see one amount, another period another amount. Perfect. Okay. Yes, students, so please pause the video, understand it yourself, and please solve it. Then we will compare the answer. I don't want to speak anything on the question. That is because whatever I need to explain, I have explained it. Okay, only one thing I want to ask students. Are you going to write the theory? Yeah, did you see? Okay, I don't want you to write a theory right now. Okay, see here. If you see the question now, they say using the definition of derivative. That means they expect you to define in the exam. In the study material, you didn't define. You just gave the comparison. Then, following the principles of recognition and measurement, will you recognize it? That theory is required now. Followed, no? But since we know that, please don't write the theory. You can straight away do the calculation and pass the journal entries. Okay, so your doubt is why do we call it a derivative loss, not a forex loss? See, even though it has come from a forex loss, but what is the nature of it? Substantially, it is the derivative contract. Derivative contract can be on the shares, on the interest rate, whatever it is. But the moment you call forex loss, see, forex loss can come from the restatement of a debtor. That is not a derivative, no, that is not a speculation. So you will change the nature of the transaction only. So let the people come to know, no, you enter into derivative. Not a genuine. Derivative means risky. That means you are betting. Why you are betting? Bring out that. You will bring when you make bumper profits. When you make losses, no, your objective, your means the company's management objective is to hide that loss somewhere so that somebody will not question them. This is the general tendency of a human being. So we are not going to permit it. We are going to the depth of it. Okay. So we will check the question. Question is simple, right? This question has come for 8 marks in your examination. Very simple thing. And they said that the market fair value, this is the fair value. Initially it was 0. It was 50,000. It has become 30. That means it's a cumulative value. They didn't simply ask journal entries. They asked you theory also. So students who have written only past the journal entries, they are last half 4 marks out of just like that. So somebody should know, should I write the theory for this? And I am showing you consistently, correct? It's not a theory is not a standalone question there. In which all forms they will give that you have to try to figure out, make a judgment there. Anyhow, so they have given you all these things. It seems to be a very simple question. Arrangement for a derivative definition. So you can say that when it is a derivative, when it meets the following 3 definition. And why did you do it? Because they asked you definition there. define. See, word define comes, you have to give a definition. If they don't ask you definition, straight away go and explaining, okay, in the given case and also and so. Analyze the word comes, you have to give the definitions. Followed, no? So the word define itself is a level 1 input for you, one verb for you. So for definition, probably they might have allocated 1 or 2 marks. Then evaluation, okay, the value of the contract is changing, the amount paid is so and so, the contract is settled in the future. Thus, in the given case, it is a forward contract, maybe 2 marks for this, and you have got a initially measured at a fair value. Initial recognition. So I will consider 1 mark. Say at least 4 mark will be allocated for the theory. Then starts your first, there is no accounting entry because the fair value is considered to be 0. Did you pass the derivative loss to derivative liability? Yes. See, very importantly, you have to remember, students, if any item goes to P&L, in whatever journal entry you pass, there are 2 approaches. One is a very risky approach, one is a risk-free approach. The risk-free approach is derivative loss to derivative liability you did. You don't want to take any risk. Then pass one more entry, P&L account debit to derivative loss. No risk at all. No, sir, it is going to take me time. It's going to consume more time. Then, to be on the safer side, in the bracket, write the treatment that you are going to take it to P&L account and give one note there. Wherever it is written as P&L account, it will be taken to the P&L at the end of the quarter or whatever period. Very clear. If you don't write this, no, actually it is taking, you are taking much risk there. How the evaluator is going to look at it, I don't know. They may, overall level, they may deduct 1 mark from overall level for not doing that, not on case-to-case basis. Then on 30th June, derivative liability to derivative gain. Did you pass this entry? Then on 30th September, derivative liability will go off, asset will come, derivative gain is going to happen. 54,000. The same question. No? And the last is US dollar is going to come to you at 62 rupees. Derivative loss balancing figure will be 1,44,000, which you can cross verify also later. Derivative asset will be return of 24 and cash goes out at 65, 26 lakhs. This entry is correct? Perfect. So you have learned. Who said it is difficult? Okay. Now let us go to the next question. Illustration 5. Now on 1st of January, Samco entered into return put option. Oh, what is this return put option? Who sell? Who is going to sell to whom? With JT. See, understand, students, entry is simple, same entries. Are you in a profitable position or loss position? That depends upon what is your position. I am telling you. Now, for this, you can't simply ignore it. Return put option means you have given one put option to JT Corporation. JT will sell you, or he may not sell because it's an option. You are the writer. Writer has got an obligation to buy whenever he wants to sell. Yeah, JT, because that's why you are told return put option. No, you entered into return put option. If they in the examination, simply they can do one thing. Return is removed. You entered into put option. Hello. What entries you pass? No, ulta entries will come there in the examination. Same number. Samco has written one option to JT. He has an option. Which option holder he is? Put option. Put option means he is going to sell to me and I have got an obligation to buy. This is the concept of a return put option. Exercise is option. If it doesn't exercise, no, not required. That's why in a return put option, I can never ever make profit. I can only make loss. Why? Because I'm a writer. The day I'm making profit, option holder is going to make a loss. Is he mad to exercise his option? He will never do it. But if I'm a put option holder, I will never ever make loss. I will see only profit entries are going to come to in my books. Understand? This is different from the previous question. I have to obligation to buy. Generally, for this madness, no, I will take a premium. Generally, this is a madness, no? That I am obliged to take a buy if you want to sell or don't want to sell. But problem is, when at what rate? What is the exercise rate? 68, 20,000, same story. Only this is different. Huh? But it did not receive any upfront amount in the contract. This is madness. Somebody is going to question, why on earth you gave one written put option without receiving premium? Premium should have been your income, no? Now, Samco is a listed company. Then they present the financial statement. For the purpose of accounting, please use the following information representing the market to market value of the put option. Which option? Put option. Put option value is a negative. For whom? For you now. Because if it was a positive, how on earth you will pass the entry? It is positive for whom? It is positive for JT. Followed, no? If it is negative for JT, he will never exercise that, no? He will never pass the entry. So when they have given you a negative 20, same, no? Same question. If I remove the question's meaning, it will change totally. For the if I remove return, no, you will not pass any entry because its value is negative for you, but you will not exercise it. Now 30th September nil, that means no gain, no loss. On last day it is 66 rupees. Following the classification principles, see, they are talking about the classification, means same story, of recognition and measurement, record the entries. Understood the difference? What they may ask you? Okay, anyhow, they will not go to that extent. They will give you these entries only. Anyhow, theory part, you can, if you want, you can leave the space, okay? I will just discuss the theory. So first I will give the same. Is it meeting the derivative contract? Yes, because the value of the contract is going to change in response to the change in the exchange rate. Same whatever we have given in the previous question, same story. The initial amount paid is a 0, but it is going to give the similar response for one of the party. For that JT, he get the same benefit, no? And the contract is settled in the future. Thus, this is the written put option contract, is the derivative contract, and initially measured at a fair value. And what is the fair value? 0. Why? Because you didn't receive any money. In the exam, if they said, okay, so much premium was paid, what accounting entry you would have passed? If at all, some premium was paid, what entry you would have passed? Bank account debit to what it is? To what? Option premium. Now, option premium, see, that's why they didn't give you, because it will be more confusion. What is that option premium? You can say it is a derivative financial liability, because this premium I received, or alternatively you can take a stand, okay, this is my income, I will recognize in my P&L account. Or you can say, look, until the contract is settled, I don't know. No. At the end of the, right now, I will say I can take a stand, it is my financial liability or income. Or at the end of the 31st March, you see, know what it is. You take an MTM position. On 31st March, yeah, it is not repaid. Okay, now I got a premium. There are two stands. One, I will say it is my P&L. Now on 31st March, I have to recognize the derivative financial liability. This is my income. Derivative financial liability is expense. Net is what? Net is loss. Alternatively, don't recognize it as a derivative. You recognize it as a derivative financial liability only, no? Because that much expense will come down for you. Again, that's why all these confusions are going to come. That's why they have not given the entry. They said we didn't receive it. Worst case, if they ask, we can transfer it to P&L account. Finish. Because effect will come same. Because how much you transfer to P&L account, that much more you have to recognize. Net effect in P&L will be same. Okay, let us pass the journal entries. So theory, if you want, you can leave some space. Please, I suggest, please leave the space. Practice it. Try to write without seeing. Look after and compare it with my PDF. Because more you write, more you understand. Because in the classroom, okay, we spend more time in writing theory that you can anyhow practice. First theory we have written. 1/1/2011. No journal entry. It would have been paid on day one because it has got a fair value. Now you are a writer, you receive the money. Now you can transfer to P&L account, finish. It's my income because you will never return it. At the end of the month, you recognize that much, how much you transfer, that much you recognize as income expense. Clear, no? Now comes 31st March 11. Tell me, what is your position? Derivative loss in bracket P&L to derivative financial liability because it has got a negative contract value for you, not for him. For him, negative means nothing, no entries in both the books. Clear, no, Soha? Now tell me, what is my entry on 30th June? You pass and tell me. What is my 30th June entry? What happens on 30th June? The loss position comes to 15,000. Liability to gain, derivative gain. September. Yes, Vishnu Priya, what is the entry? Vidya? 30th September. Huh? No entry. Its fair value again became 0. Then what about that one liability sitting in your books already? Out of 25, 10 you written off. 15 also gone. No, that means no profit, no loss for me. I'm very happy. So you'll pass one more entry, derivative liability to gain. This is the difference between this question and the previous question. Clear? Now tell me, what is my entry on the last day? Okay, I'll proceed further. Yes, on 31st December 11. What you need to check first? First of all, which contract is this? Written put option. Is this option exercised or not exercised? At what value? 66. Means what happens? If the option is exercised, what is the outcome? What's going to happen on earth? I'll pay money and I will receive money. Which money I'll receive? Dollar, because it's a written put option. The opposite guy is going to sell the dollars to me. So US dollar debit. At what price? Because 68 is one old story. Today, what is the fair value of this financial asset? On the day of the execution, 66, no. Today's date's fair value is 66. So $20,000 into 66, 13,20,000. To bank, how much do you pay? 68, 13,60,000. Is there any derivative liability or asset pending that for writing off? No. So the differential amount will be P&L. You can cross verify this. How do you cross verify this? You agreed to buy at 66, 68 and the market price is 66. You are unhappy because there is a loss of 40,000. That's it. Are you very clear conceptually what is derivative accounting? Because in the next step, we have to take a decision whether should I remove the derivative component and pass this entry or should I club it. That's called embedded derivative. It is like a compound instrument. First, before learning compound instrument, we understood what is financial asset, financial liability. In compound instrument, it is a mixture. So we removed that financial liability part and said balance is my liability. Like this, we are supposed to do now. That's why first we need to understand the derivative financial. Now we will move on to the embedded derivative. Okay, understand very clearly, students. Very simple actually. Once you need to understand very clearly. Yes. Sorry. Yeah. Which one? US dollars, sir? No, US dollars I didn't get only, no. After I get, like on 31st December, I got the US dollar, no. From 31st March 2000, next year onwards, then I have to restate every year. This is called a monetary asset. Now, for this, now onwards, India's 21 is going to come. I'm telling you, student, yeah, we'll, good. Your question is very nice because I'm feeling very happy that you are thinking, opening up your mind. See, as we proceed, no, we see one interconnection between the standards. Then, no, when we look at a question, so many things will come to our mind automatically. Oh, what is this? How is this going to happen? How subsequently it's going to happen? It should be capitalized. Then you are perfect, ready product for financial accounting. Followed, no? So now we will understand about the theoretical part. Yes, students. So now we will discuss about the embedded derivative. See, understand the principles and the rules of this embedded derivative. What is an embedded derivative? It's also called a hybrid instrument, like a compound instrument. In compound instrument, we have got a financial liability and equity, no? But in a hybrid instrument, one leg is a derivative. Another leg can be equity or financial liability. So when a financial instrument contains equity or financial liability on one side, derivative on the other side, it is called hybrid instrument. Now, when do you say an embedded derivative? An embedded derivative is a component of the hybrid instrument. That means there is one big contract. In that contract, one small element is a whose nature is like a derivative. It's a derivative only, not nature. But they mix it. So that included in a non-derivative, that means the main contract is a non-derivative. Its value is not going to change. It's perfect. But what you do, you change the nature of the main non-derivative contract by mixing one derivative contract so that the effect that some of the cash flows of the combined instrument, so previously it was fixed cash flow, because of one variable element, no, the combined cash flow becomes variable, which is similar to the standalone instrument. It's going to give that effect to you. If you don't mix, life is simple. Tell management why you're mixing. When you issue when you take the or issue the debenture, don't give them prepayment option. Finish. Life is simple. But if you give the prepayment option, that option can be a derivative contract. Its prices are going to change now. Instrument taken as a whole, it's not fixed now anymore. Example, bond with the conversion price. Bond is a host contract. Conversion option is a derivative contract. We already did in compound instrument. But since that conversion option passes fixed for a fixed test, we call it compound instrument because even though it is a derivative, it's a debt and equity. What if that option fails financial liability, this thing, what's that called, fixed for fixed test? Then you call it financial liability. No, it's a derivative financial liability. You can't call it financial liability anymore. The host contract is a financial liability, but the embedded contract is a derivative financial liability. Then this becomes an hybrid instrument. Second question comes, should I do a combined accounting or should I do split accounting? Because in compound instrument, we generally do split accounting. Here, we have to follow certain test. Based on that, because people are very smart outside, all experimentation is done. What we are seeing is a fine product of a research, experiences. Auditors understood how people will fool. You know, before one standard comes, there is something called a draft standard exposure. You know that, no? That means they will prepare a draft, send it to everybody in the world and say, please give me your comments. Now, when I go through the standard, see, that's why learning is a continuous process. For you, doesn't stop here. You are learning what to learn in the future. You are getting one base here by learning limited things. Going forward, when you go through that bare standard, a draft standard, suddenly you realize, oh, one of this part is applicable to your company. And in your company, you have seen one scenario there. You see that this is conflicting or it is not addressing, like option premium we received. Standard is very silent. How to pass the accounting entry for option premium? Should I take to P&L account or should I take it as a liability? Then what I do? Immediately I'll send one mail or letter to that task group, India's task group, telling, look sir, I have come across this type of scenario. Please give me more guidance here. This is what my company did. I will not tell the name of the company and all, but I'll give you one case study. This is happens. Then they understand, oh, people do like this also, no? Then they will strengthen the standard by telling, okay, in such circumstances, test these things. If this pass, do this. If this fails, do this. That way, a standard becomes strengthened because there are so many people mind there. Why we are doing all this test? Because one of the person, some Bangladesh or some India or some Baluchistan, God knows. Intelligent minds are there throughout the world, no? So that intelligent mind is countered in the form of standards. So, if you have got a lease contract, 116, or have a normal lease, no. What did you do? You connected that lease with the inflation factor. Then your consideration become variable now. Generally, when you give lease, you have got lease rent. How do you enter into contract in the lease? You have seen the lease contract. What is your understanding? He says, sir, I'll pay 10,000 rupees per month every rent. Okay, what about next year? I'll pay next year 10% up. That means on day one, do I know how much amount I need to pay throughout the life of the lease? I know. There is a variability, but it's a fixed 10% increase every year. But I enter into a lease contract in such a way that my lease payment depends upon the inflation factor, which is released by the government of India every year. Now, my value of the lease depends upon the inflation. If the inflation falls, my contract value also, lease payment also falls. And that means you are embedding, Baba, you are doing something odd transaction here, which is not a normal transaction. Now, people generally don't do that. Then I should take your lease contract to that test to check whether the derivative, are you trying to hide the derivative contract there? So, adjustment of the price inflation factor is an embedded derivative. Export of goods in dollars. Now, a sale contract is a host contract, but you have taken one forward also. No, one forward is sitting there in the export contract, forward buy, because you wanted to enter into forward buy. You didn't want, because forward buy you enter, then you say, Samco, sir, you are Samco, pass the entry. I don't want to pass the entry only. Instead, I will export in dollars. The moment I export in dollars, I will get $20,000, no? I want $20,000 on 31st December. Is it necessary that I should get from bank only? Not required, no. I can export to USA in dollars. That customer will pay in dollars. So my objective is to get the dollar. If I take dollar from JT Bank, you will ask me to do MTM. I will not do that. I will buy export in dollars. So I got my dollar without MTM. Finish. So my host contract is the sale contract and dollar contract is the embedded derivative. Sorry? Why do we need to do the MTM? Because I am a listed entity, no? Mark to market, see, if it is a futures contract, every day MTM happens and margin money call is going to happen. Then I am left with no choice other than passing that entry for margin money in futures contract. But in forward contract, since forward is an OTC contract, over the counter, it is not through any stock exchange. That's why whenever I am going to close my books of accounts, it's called a reporting period, then I have to do the mark to market. That's why in between I don't do that. But futures, I do it on every day. End of the reporting period. Whenever, maybe if you're doing half yearly reporting, half yearly. If you're doing monthly reporting, monthly. That your jurisdiction has to say. That's why in the previous Samco, till now, in any question, have you seen listed entity? You have done so many questions. In any single question, did you see listed entity? No. Why they gave you listed entity in this? Why? Because you have to close quarter. They didn't tell you. You have to understand it. Now, how to account it? Okay. Now, question is, hybrid instrument will be accounted as a single contract or you will do split. Now, you need to understand the rules, students. Pay your full attention. Ask me if you are not clear. When should I separate? See, accounting it as a single contract is not a headache only. That means both the derivative and the host contract, I will say, I don't want to split there. Like in compound instrument, we were splitting, no. Like I don't want to split. So what entry I will pass? Financial liability account debit to bank, finish. Bank account debit to financial financial asset to bank, or bank to financial liability, simple. But sometimes I may have to separate. When? Under certain circumstances, you are required to separate a host contract and you need to account separately. Okay. When I need not separate it, if any of the following condition is fulfilled, no, I can account it as a single contract. If all the conditions fail, then I have to separate it. 1. The host contract is measured at FVTPL. Then you separate, you don't separate. Does it make any sense? No, because even though you separate it, embedded derivative, how do you account it? FVTPL. Host contract, how do you account it? FVTPL. You take the fair values and both the fair values you take to the P&L account. So, separation makes no sense, no. But the separation makes sense when the host contract is taken to the balance sheet, amortized cost. Embedded derivative should have gone to P&L account. Then it makes sense to separate it and show every word. Look, Baba, these people are trying to hide one derivative in one host contract. Understood? So the first condition is if the host contract itself is FVTPL, then separation not required. You can account single. Now, embedded derivative face the definition of derivative only, obviously. You are calling it derivative, but it is not in reality derivative. That means either it is future settlement has failed, or you have paid upfront amount full money, or it is not having that underlying, whatever it is, one of the three definition not failed. Then there is no question of separation. The third, it passes close relationship test. Now, what is this economic relation characteristics and risks test? One test comes now. It says that the economic characteristics and risk of the embedded derivative is closely related to the host. That means the derivative what you have put there, that and the host contracts are like brothers and sisters. Very closely related. I'll give you. That's what we need to focus, because we have to write this theory in the examination. For this, you need to know what that theory means. Now, what is this close relationship? For example, in the study material, they have given two examples, because two problems they have solved. Keeping that two problems only, all the problems in the world we need not sit and discuss right now. Our priority is to understand those two problems. What is one example they have speaking about the debt prepayment option? Like whenever Karnataka Bank, you have taken one loan from Karnataka Bank or SBI Bank. Generally, will they give you an option to prepay it? No, you have to generally, if you enter, okay, they may prepay with certain deductions. Okay. So, when the prepayment option is sitting in a loan contract, loan is a non-derivative contract, option to prepay or not, which you will exercise when it's beneficial to you, when you will exercise. If the interest rate has gone up, you will prepay it. Interest rate has not gone up. If it has gone down, you will continue it. Is Karnataka Bank mad enough there to give you prepayment option? That's why generally they will not give you prepayment option. Otherwise, you will take your advantage. In that case, they say, okay, then give me option for me also. It's not just you. Give me option. Let both the parties apply this option. So that when the interest rate increases, okay, then that becomes a clash, no. Because when the interest rate is not going to happen, that's why generally this clash is going to happen. No party will not do it. Or if you want, I will give you, but you have to pay me high rate of interest. And that higher rate of interest what you paid, it is the option premium you pay to the Karnataka Bank. Otherwise, if the Karnataka Bank wants to hold this option, what Karnataka Bank will do? If the interest rates are going to fall, I will prepay you. because my realization is low. If it's going to raise, okay, I will continue. Okay, whatever it is. Both the parties will exercise the option whenever it is favorable to them. So if the Karnataka bank wants to hold that option, the rate of interest what it has to pay to the loan is like chargeless. Borrower will get the benefits. If the borrower wants to get this option, they have to pay high rate of interest to the bank. Whatever it is. The differential between normal without option and the interest rate with the option is the premium one of the party pays to the other. Now the standard says a prepayment option embedded in a host contract is closely related. Is that option and the host contract is related? Yes. When the option exercise price, one price would have been given to you. You remember first quiz 11 lakh rupees. 10 lakh 60 was to be paid next year. This guy pays 11 lakh. Debenture 5 lakh 25,000. It's called exercise price. If that exercise price is closely related to the amortized value on each exercise date, then you need not separate, because amortized value is nothing but the present value of future cash flows. And I will give you an option to exercise at any point of time. If that value and the present value of the future cash flows are almost similar, then okay, we can say it's a normal option. It's not an embedded option. You're not trying to hide something. So you want to separate it, you don't want to separate it, doesn't make any difference. You can continue because there's nothing suspicious there. But what you want to exercise is totally different from its closing balance. Then the relationship or the characteristics between the option and the host contract is different. That means it fails. Are you clear? If the test is passed, you need not separate. Bit confusing, but you have to practice this. Next, a foreign derivative contract. Now, a foreign currency derivative contract, an embedded foreign currency derivative, that means you exported or imported in foreign currency. Generally, when you sell in India or buy in India, you do in INR. Is there any, in that contract, is there any derivative sitting? No. But the moment you export or import in dollars or other foreign currency, one derivative contract will be hidden in that or sitting in that. It's an embedded, either forward buy or forward sell. Now, for sale or purchase of non-currency is closely related to the host contract when it requires the payments in one of the following currencies. Now, say for example, you are in India. You are in India. The exporter is in China. We will take two imports. You have imported oil in dollar. You have imported toys in dollar. Now, what is the contract here? To purchase oil or toy? Toy or oil, is it a financial asset or a non-financial asset? Non-financial. It's not a financial. We have gone through the definition. Now, that is called a host contract, which is a non-financial contract. Now, is there any foreign currency derivative sitting? Yes, a dollar contract is sitting there. Because if the dollar is going to change, your import value is going to change in both the places. Whether you import oil or we import toy, both the places your contract value is going to change. Now, is it a derivative? Yes, because you are going to settle in the future. You didn't make any investment right now, and the value of the contract is going to change as per the underlying. Which is underlying? Exchange rate is the underlying. Now question comes, should I separate it? Should I remove that and pass dollar separately, toy purchase separately, or oil separately? For this, the third test I need to apply, okay, called the economic test. Is it closely related? Is this dollar payment and what you buy, is it closely related? Where? No, what I mean to say, okay, for this they said, you should have, it is closely related when you make a payment in one of the following currencies. One, functional currency of the party of the contract. That means whether you import toy or oil or anything on the earth, if the contract is in rupee or Chinese yuan, chalo, you need not separate it, because it is the functional currency of one of the party. That means there is a close relationship between what you import and in which currency you pay. Even though you may enter into a Chinese yuan is a derivative for you, Indian person. But Chinese yuan makes sense. No, when you import from China, Chinese yuan makes sense. So you don't have anything to hide there. Are you clear? You are not trying to hide anything there. You are not trying to speculate there. Because that guy demanded, you paid it. And if you still insist, please separate. See, it is going to cause a lot of accounting hardship on me. Sit and separate every component there and pass MTM, derivative accounting. So to ease, they said, look, if you import from China in yuan, you need not do it. Or currency routinely used in the commercial transaction across the world for such goods. Now, across the world, whenever you import oil from any country, in which currency you pay? Dollars. So, if this contract is not in rupee, not in dollar, not in Chinese yuan, but is in dollar, first thing you look, what is that goods you imported? Oil. Chalo. That means there is a close economic relationship. You need not separate it because generally they are paying in dollars only. But toys, not acceptable. But for a toys contract, it is going to fail. Because somebody will ask you, Arey Baba, you are importing from, what is it called, China. Either you pay in Chinese yuan or rupee, acceptable. But for a toy, why you are paying in dollar? What relationship dollar and the toy has got? Dollar and oil has got a relationship because it's a global currency for oil. That's why economic characteristics is not matching there. You have to separate it. Or currency commonly used in the economic environment in which the transaction takes place. Like if you go to Nepal, in Nepal, Nepalese currency works, INR also works. Like if you would have imported toy from Nigeria in dollar, makes sense. Why? In Nigeria, dollar also works, Nigerian dollar also works. In India, what works? Only INR works. Is there any parallel currency there in India? No. In Nepal, there is a parallel currency. You can buy some water bottle in Nepal, pay in rupee, they will accept it. Because the economic environment generally accept it. See how intelligently they drafted this. Then they said, look, okay, let me take back you to again. If you mix any embedded derivative and embed it in a host contract, question comes, should you separate and pass the split entry or should you pass the single entry? Depend upon 3 tests. Test number 1, is the host contract FVTPL? If answer is yes, chalo, no need to separate. Because separation makes no sense. No, then look for second. If this fails, look for second. If this passes, then there is no question only. Second, is that embedded derivative, is it really derivative? If no, look for the third. If yes, if it is not an embedded derivative, question of separation doesn't come. Third, check whether the embedded derivatives characteristics, economic characteristics, match with the host characteristics. No, this depends upon circumstance. I cannot give a universal definition here. This depends upon type of transaction which I am entering into. So, they in the study material, they explained you 2 type of transaction for doing the third test. First test is on the debt repayment. If they say that if you have got a repayment option in a debt, is that option to repay is a derivative? Is it matching to the host contract? Do one thing. If it is closely related, the option price is, exercise price is related to the amortization, then debt and your option are closely related. If it's closely related, why you want to separate? That means this has passed. The moment one of the things pass, you need not split. But this also fails. So all the 3 things fails, you have to separate. How do you separate? Simple. From the transaction price, deduct the fair value of the debt. Balancing figure is the derivative. Same like compound instrument only. What if you are importing? Then they say that when you have imported, your import can have one foreign currency derivative there. Is that foreign currency derivative and the import host transaction, economic characteristics is matching? They say that it will match if Any one of the currency is sitting there. Either the host currency, the functional currency of the importer or exporter is there, then economic characteristic test passes. If it passes, then you need not separate it. No, it is not my currency, it is not his currency also. Okay, is that currency in which that particular transaction, goods, is generally traded? If answer is yes, then you need not separate it. Pass as a single contract. This is also no. Chalo, no problem. Have you traded in a currency which is generally acceptable in his environment or in your environment? A parallel currency. If this is also no, then on what basis did you enter, Baba? Then why, when you imported from Kenya, you have entered into Ugandan dollar there? What you are trying to do here? I am not able to understand. Where is the relationship to an Ugandan dollar and a Kenya's import? You enter into Kenya, understandable. From Kenya, you import oil, understandable. But something you are importing and some other currency you are paying, that means you are speculating in one of the currency, no. What you did intelligently, you drafted a contract. Beautifully, that speculation you incorporated here. Very intelligently. Accounting standard was hand was tried like this. Accounting standard could not do anything. But this is a global standard. Research of so many people, principle based. They say, okay, my hands are not tied up, Baba. I'm going to separate it now. And I'm going to pass embedded derivative, embedded contract entry, and this contract separate. You go and explain to the world now what happens. You say, sir, what this accounting entry? This accounting entries, don't ask me. Go and ask whom? Management. First of all, why they entered into contract like this? Are you clear? Interesting? Beautiful. So split accounting, embedded derivative, how do you check it? See, transaction price minus fair value of the, if you know the value of the embedded derivative, you don't know the value of the host contract. Like equity contract, you don't know. Derivative contract, you know. Simple. From the transaction price minus the fair value of the embedded derivative, you get the fair value of the host contract. No, sir, I know the value of the host contract. I don't know the value of derivative. Simple. Transaction price minus host contract gives you the embedded derivative. Now, if you don't know both, then what to do? Both you take it to FETPL, finish. Now, split accounting is followed when the embedded derivative needs separation. In case fair value embedded derivative can be measured reliably from the host contract, they deduct the fair value. Okay, same theory. Okay, same theory I have explained in the form of a chart. See, which is beautiful, friend. This explanation is beautiful or this picture is beautiful. That's what I tell you. This is mind mapping. I suggest please do this mind mapping rather than writing theory. It's the same thing. If the fair value of the both are not clear, take it to FETPL. Otherwise, for me, explanation becomes difficult here if I don't have the charts. Now, what is my accounting guidelines? Accounting guidelines for the foreign currency derivative contract, initial recognition. Now comes, they say that the host contract, okay, this accounting guidelines they have given for this import or export. So if you have done import or export other than that currency, normal currency, host contract is a sale or purchase for a normal transaction. You have to account in the functional currency of the reporting entity. That means in INR, since we are talking about Indian people. At which value I should convert then? Because my contract is in dollars. They say pass entry in INR. Then what you need to do? Functional currency is determined using the forward exchange rate. Right now, you have to say on the date of settlement of the contract, which forward rate is applicable. At that rate, convert right now and pass the entries in INR. And the embedded derivative, what you separated, no, to treat it like a forward contract. Just now, we have not done now. Samco, same. Previously, it was hidden. Now you take out host contract, you account in INR only. Previously, you would have done in US dollars, host contract. Now, since we have removed it, previous host contract, you account in INR. Embedded derivative, account it like embedded derivative. That MTM. Subsequently, all the changes in the embedded derivative will go to P&L account, derivative gain or derivative loss. Host contract, unless it is fulfilled, because host contract is a forward contract, executed contract. So this you should pass the entry only on the date of settlement. So no accounting entry will be passed. We'll solve one problem. You will get a fantastic idea about this theory. Now settlement accounting. Now why we are doing on the date of settlement, delivery of the non-financial item is going to happen. You will pass the entry purchase account debit or import account debit or machinery account debit. Embedded derivative settled no on that day, because what we separated, it got closed on that day. So the foreign currency debtor or creditor, so you say machinery account debit to foreign vendor account. And since the embedded derivative is closed, the closing carrying amount of the derivative is added or to the host contract. You remember when the dollar was purchased last on 31st December, what did you do with that balance of derivative asset? You transferred, no? You closed that, no? Like this, on the date of settlement, you have to close that embedded derivative by transferring it to the debtor. Looks complicated, no? But that's it. That's what it is. No, we will solve the problem with this derivative part. We will be done. Let us see the questions. Then it should give you very dot clarity. Yes, sure. So we will just again have a quick recap of a theory, and then we will take a break. See, first hybrid you understood now. Hybrid means one leg is equity or a financial liability, other leg is a derivative. That's called hybrid. So embedded derivative is one of the component of the hybrid, which is a non-derivative in a non-derivative host, so that the effect is the same. It will give the entire contract. No, it makes variable. So your host contract can be an equity, lease, debt, or a purchase or sale. Every type of problems are not discussed at your CA final level. They discussed only one contract here, one contract here, one question. Here, 2-3 questions are there. That's it. They didn't discuss these things. They just theoretically discussed for your academic. Now, what can be an embedded derivative? It can be a prepayment option of a debt. It can be a conversion of a equity which fails fixed for fixed test. Because if it fixed for fixed test passes, you take it to compound instrument. Or it can be a forex option in for executory. It can be commodity here. It can be prepayment of the lease. It can be variable index of the lease. It can be anything. Now, how do you separate? If optionally convertible loan is given, do we need to separate equity? Okay. A fixed loan with the prepayment option, import of PP amount payable in dollars. That's why 2 examples I told you. A loan with the prepayment option, import in other than functional currency. So embedded derivative need not be separated if 3 conditions, any one is false. Host is FETPL, or that embedded derivative fails derivative test, or economic characteristics is closely related. If any one is ticked, that means not required to be separated, any one. If all the 3 are unticked, then you have to separate. Economic characteristics, they gave you 2 examples. Prepayment option, if the option exercise price is very closely related to the book value of the loan at any point of time when you can exercise, then separation not required. Then foreign currency derivative, we discussed the functional currency when it is closely related, when the functional currency of substantial party to the contract you have entered, separation not required. Or currency is routinely used like crude oil, dollars, not required. Currency commonly used like Nigeria, dollar, or US rupee in Nepal, not required. Okay, so accounting guidelines. So first, initial accounting and subsequent accounting. Initial accounting, host contract is accounted in the functional currency, say rupee. Even the contract is in dollar, no, you account in rupee. And that embedded derivative, you treat it as a foreign exchange dollars contract. And embedded derivative is a forward currency contract. Now, buy or sell, I will tell you the logic later. That is one catch. Now, no accounting entry is passed for the host contract because it is an executory contract, and no gain or loss for the forward derivative on day 1, because we have understood that whenever we separate, that is day 1. On day 1, do we pass entry for derivative contract? No, fair value is 0. Agreed? See, and students, I'll tell you, when you speak this language, confusing, but once you get a hold, you speak this language in the interview, you speak the language with your friends, you see how much difference it makes in you. This language should come to you. Without practice, it's not going to come. So that your mind is going to process it. The more you work on it, you will understand it. Subsequently, changes in the fair value of the forward contract is recognized in FPL because it is FVTPL. Forward contract is a derivative. And on delivery, the host contract is fulfilled, embedded derivative is settled. It will go to the host contract. Foreign currency debtor or creditor is recognized, and the closing carrying amount of the derivative is added to the host contract. Let us keep these guidelines and solve the problems one by one with the question 46. Same theory I will explain you while solving problem.